I get asked about rental cash damming more than any other strategy I teach, and the questions are always the same. So today, I'm going to be answering every single one of them. And if you've ever had any questions about rental cash damming, then it will likely be answered in this video. Okay, so we got to start somewhere. Let's start off with the basics of going through what rental cash damming is and why it's so effective. So, if you know rental cash damming and you've seen my videos, then you can fast forward this question. But in a nutshell, what rental cash damming is it's a strategy that allows you to convert your personal residence mortgage into a tax deductible loan if you own a rental property. That rental property needs to be in your personal name. We're going to dive into that in a bit here. How it works is you use your rental income to pay down your personal residence mortgage. You then borrow from a home equity line of credit, the HELOC that's attached to your mortgage, to pay for those rental property expenses. The interest on that HELOC is tax deductible. So your personal mortgage is going to shrink aggressively because, again, you're taking the rental income and making that extra payment every single month on your primary residence mortgage. So that's getting paid down aggressively, and you're going to see your line of credit grow over time. And this is a good thing because we're getting rid of that non-tax deductible debt, which is your primary residence mortgage, because the default in Canada is we cannot write off the interest on our primary residence mortgage. But doing this strategy allows us to write off the interest on the line of credit. So over time, your tax deductions are going to grow. You're going to either receive a tax refund at the end of the year if you're employed. If you're self employed, you're likely not going to receive a tax refund because you likely are going to be paying taxes if you're sole proprietor, but it just means that you're paying less tax. So either way, you're getting tax benefit from this. And once you get that tax refund, if you are employed, you can do whatever you want with that. But we recommend the default, the standard is to take that tax refund and apply it directly to your primary residence mortgage to further accelerate the strategy. So we already talked about the result of running rental cash statement. I guess the only other thing I would add is that there is no extra cash flow needed. This could be a separate question. In fact, it might actually be one down the line here, but I'll just touch on this briefly. When running this, you service the interest on your line of credit. So you don't have to make those payments out of pocket if you don't want to. You can, but 99% of people running rental cash, I mean, they will just service that interest from the line of credit itself. And in fact, I'm remembering now that is a question that we're going to dive into, and I'm going to explain the flow of funds and how we do this. So, question number two, is this legal? Yes, 100% it's legal. I wouldn't be talking about it if it wasn't. The CRA specifically allows this in the income tax folio S3, F6, C1. It's a mouthful, but just literally search that on Google. You can see the breakdown of it given by the CRA. It actually references cash damming in it. So, it's a recognized strategy from the CRA. The rule with this is the interest is deductible when the borrowed money is used for income generating purposes. That is the key. You cannot use your line of credit for personal expenses. You cannot mix the two. That's where you will find yourself in a lot of trouble with the CRA. It can unravel a whole can of worms if you ever do get audited in the future. So it's very imperative that you set this up properly and it's structured properly, and that you're doing the ongoing expense tracking, and that you are not borrowing for personal reasons, personal funds. So the key is, just talked about this, you do need to trace where that borrowed money went and where it's going, and just keep your accounts separate. We're going to talk about the account structure in a second here. Question number three, how is it different from the Smith maneuver? So both strategies convert your mortgage into a tax deductible loan, but the main difference is the Smith maneuver, you're borrowing to invest in stocks or funds. Think S&P 500, wherever you are investing. That is the Smith maneuver. With the cash damming strategy, we are not investing. We are simply just moving the rental income and transferring where you are putting your money. We're moving things around. We're making two extra steps than you're currently doing as a landlord right now. There is investment risk with the Smith maneuver. There is more inherent risk there. It doesn't mean that it's not a great strategy. I personally run the Smith maneuver and cash damming, but there is more inherent risk, and that's something that you do need to know. The benefit from the Smith maneuver really comes from the investment growth and the tax deductions, but mostly the investment growth. And when we break down the numbers on the Smith maneuver, that's where we see a lot of it. And in fact, um, Actually, I'll touch on that in a second here. But with rental cash damming, we're borrowing to pay for rental property expenses. There is zero investment risk there because again, we're not investing; we're just transferring where the funds go. And the main benefit is the tax savings, and this is huge. The mortgage pay down. That's where we see a lot of the wealth benefit is from that mortgage pay down from that rental income coming in. So, can you do both? Absolutely, you can do both. You do need to have separate line of credits for this, or you go ahead with the Manulife One product, which is our favorite and our recommendation for someone that is running both strategies or that has multiple rental properties. And the reason being is because when you commingle both, it becomes very hard to track and it's very messy, and it just opens up the door for the CRA to not accept the interest deductibility if you're mixing things, or let's just say down the line you want to invest or you want to sell one of your rental properties, then you got to back everything out and it becomes very messy. Question number 4, what do I need to get started? So you do need 3 things. You need a rental property, of course. That can be either a positive cash flow or negative or neutral. Doesn't matter if it's local or out of province, but it must be in Canada and it must be generating rental income. You do need a mortgage on your primary residence home. Otherwise, there's no point in running this strategy. The mortgage on your rental property is already tax deductible. So you've already got the tax benefits there. You must have that equity available on your primary residence. You need at least 20% equity in your home in order to have access to that line of credit in that readvanceable mortgage. You need to have separate bank accounts. So you need one for the rental income. So that's where you've got your rental being deposited into that. Now, technically, you don't need that rental income checking account. And that's all it is. It's a checking account that the rental income gets deposited into. You can actually have it into your checking, your regular day to day checking account. But I like to keep it super, super clean, as well as our accountants. That's their general recommendation is just to have that separate account. So I always err on the side of caution and just make it super easy in case of that future audit. You need one for the rental expenses only. We call this the clearing account. That is imperative. And you need one HELOC for the rental borrowing, so the expense borrowing. This is really oversimplifying it. Everyone's situation is very unique. So you do need that team. And you're going to hear me reference this throughout this video because it's super imperative you have that team that knows what they're doing, that can allow you or that can help you structure the right structure up front out of the gate. Because again, it comes down to can you prove this to the CRA that you're using this properly? All right, question number 5, what expenses can I pay with the home equity line of credit? So basically, the majority of rental property expenses. So I'll just leave this here for a second, but all of this here, right? There's a couple cases where when it comes to using the line of credit for repairs, that's where you really need to check in with your accountant. And I'll also just put a disclaimer here. I'm a mortgage broker. I'm not an accountant, so I'm not going to go into this into too much detail. But you should have an accountant if you are running this strategy, and you need to know what can be included in this. There's separate things outside of this that are that might default to a different area from a tax deductibility perspective. So when in doubt, always check in with your accountant. Yeah, we already talked about that. Don't pay for personal expenses ever. Just don't do it. Question number 6, do I need to incorporate? No, you don't. So this actually works as a personally owned rental property. There is ways where you can do it if it's incorporated, but we personally don't help clients that have the property in a holdco. It's just very, very convoluted and messy. So we always recommend if you are running rental cash damming, own it personally. And we've even had clients that have 4 or 5 properties in their portfolio and they're all in holdcos, and they chose to go forward with their next property in their personal name because they do want to run rental cash damming and they see the power behind the strategy. And that's my general recommendation too, is if you are incorporated with all those properties in a holdco, consider owning one in your personal name. Question number 7, what if my rental property is cash flow negative? So this strategy still works. If your rental is losing $500 a month, you're already borrowing or using savings out of pocket to cover it. So you can borrow from your home equity line of credit to cover the shortfall. But just keep in mind, you do need to have room on that line of credit to be able to service that negative cash flow. So that's where it really comes down to building out the budget for you, making sure that you do have room in that line of credit. If you don't have room, then unfortunately you do need to continue servicing that negative cash flow yourself, which you're already doing anyways. So really you can run rental cash jamming with a positive, negative, or neutral cash flow. If you are servicing the negative cash flow in the line of credit with rental cash jamming, a quick note here is that you do get greater benefits by not absorbing that negative cash flow, but it's great as a temporary relief for cash flow pain. So we've had clients that were negative cash flow $600-700 a month, and they were feeling the pinch financially on a month-to-month basis. So we're giving them relief for the first couple of years until they can reevaluate, because it doesn't mean that you have to absorb that negative cash flow forever when running rental cash jamming. Question number 8, what accounts do I need? So the cleanest setup here, we kind of already touched on this. I'm just going to leave this here for a second. Rental income, talked about that. Rental expenses, so that's your clearing account that we talked about. You're paying for all of the rental costs here, and that is funded by your line of credit. The flow is you take that rental income that then gets transferred to your personal account. You make that extra mortgage payment from that personal account. Then you borrow from the line of credit to pay for those rental property expenses. That is the flow. There's nuances there. Again, everyone's situation is different. And when it comes to servicing that line of credit, I'll touch on this for a second. When you're borrowing from the line of credit to service those rental property expenses, you're going to take a bit of a buffer from that line of credit here. And that's going to go into the clearing account here. And when you do this, you're going to have that buffer in the clearing account, which you then transfer that buffer back into the line of credit to pay for that interest only payment. So that's how you're doing it there. You're taking that buffer every month. Some clients like to do the down to the exact dollar and calculate what that interest only payment is going to be. Me personally, I like to just keep 2 or 3 months worth in the clearing account to act as a buffer, because sometimes I might be on vacation or I get behind on doing the transfers. So having that buffer in the account's always imperative in case you slip 1 month. Question 9, how do I pay for the intro? Oh, I'm already ahead of this. There you go. So we just talked about that. We're going to go to question 10. What if my bank has limited prepayment privileges? So yeah, this is one we come up with, or we come into all the time. I'll just name it RBC. They're the worst lender for rental cash jamming. They have a 10% prepayment privilege, so it's very very hard to run cash jamming. It's not even the 10%. Like, a lot of the times, if it's a big mortgage, you do have a lot of room within 10% of the prepayment privileges. But where the real limitation is with RBC, you can only use that prepayment privilege once a year on the anniversary date. So you can't run this on a month to month basis. The workaround is we have to use double up payments that RBC has. But again, that's capping you on how much your actual monthly payment is. If your monthly payment is $2,000 on your regular mortgage payment, but your rental income is 4,000 across all properties that you have, or maybe it's just one rental property, then you're limiting the benefit of rental cash jamming by slashing that rental income payment, the prepayment, by 50%. So unfortunately, we do have to move clients to another lender, ideally Manulife Bank, Manulife One product, or Scotiabank. That's like our one and two, because they have way better prepayment privileges and it doesn't restrict you on running a cash jamming. So your options here, you can wait until renewal. If this is you and you're sitting there like, I have a restricted lender, you can wait until renewal and then we transfer you to a new lender. We refinance to a new lender. Or you can you can break your mortgage right now. You can refinance, and that usually makes sense if the savings outweigh the penalty. Depends on the penalty you have. If it's a variable rate, then it usually always makes sense, because the variable is a lower penalty. But if it's a fixed rate, sometimes with the big banks, the IRD penalty can be pretty high. So we just want to run that. And an option two here is you do what you can up until renewal. So we can still run rental cash jamming with those double up payments. It's just going to be restricted until refinance time. But some people are like, let's just rip the band-aid off and get it set up properly right off the bat, which is always the clean way to do it. So best practice when you are setting up a new mortgage, make sure they have the flexible prepayment privileges. There's other nuances with the lender that you need to know, which we want to get into this video, but just know that not every lender is treated equal when running cash jamming. Question 11, what happens when I sell the rental? So the HELOC becomes non-deductible, and the CRA, they care about the current use of the borrowed funds. So if you borrow to pay the rental property expenses, you no longer have a rental, and the current use is gone at that point. So if you do sell, your options are you can pay off the HELOC when you sell. Number two, you can wait until you're mortgage free. Some clients can accomplish this in under 10 years. when running cash damming if they have multiple properties. It's not uncommon. But for a lot of you, if you are running cash damming with one property, then usually we're debt converting around the 7 or 8 year mark, and then we're mortgage free depending on the amortization they have. It could be around year 15. So sometimes it's better to just wait until you're mortgage free and then sell your rental property. But obviously things happen, and that's why we have some safety measures on the back end when we set you up properly. And that comes down to the right mortgage product and the expense tracking, where it makes your life a lot easier if you do sell your rental property. Yeah, and then just a quick note here: if you are selling in 2 to 3 years, there's no point in setting up rental cash damming. I would even argue if you're selling in 5 years, you know, just don't even bother, because you're going to see the benefits come later in the cash damming process. So if you kind of have an inkling that you are going to sell, just maybe just skip the strategy entirely. Question 12, do I need an accountant? Yes, absolutely. We already talked about this. This is a tax strategy. You need someone who understands rental income tax rules, who knows how to track deductible versus non-tax deductible debt, and can represent you if the CRA does audit you. It's very important. I should have added it here too, that they are SMCP qualified. So Smith Maneuver certified professional. I myself am one. Anyone that's running cash damming strategy or the Smith Maneuver, they should be trained and licensed to run these strategies. So we always come into, some clients prefer to keep their accountant, which is absolutely fine. But we always want to make sure that we are on the same page and that we teach them what the strategy involving. Yeah, always have an accountant when running the strategy. Here's what they're going to need from you. They're going to need those separate bank statements for each account, the HELOC interest statements, proof of the borrowed funds went to the expense, rental property expenses, and the records of the rental income and expense tracking. So a long list there. I'm not going to get into too much there. Again, I'm not an accountant, but they need everything that you're doing. Yeah, don't cheap out. Good accountants will save you way more than they cost. I often see a lot of people try to do the taxes themselves, and it's just the wrong way to go about it. A good accountant will save you that money over time. Question number 13, does this work with multiple rentals? Yes, even better. The more rental income you have, the faster you can convert your mortgage. So the best practice here is to keep each rental expenses in a separate account or clearly categorized. You can use this on one HELOC for all rentals, but just make sure that you are tracking it properly. That comes down to something like the Manulife One product, where you have that the tracking features and capabilities within the all-in-one account. And then it matters because we talked about this. If you sell one rental, then you need to know how much was used on the HELOC for that specific property. Question 14, can I do this with an Airbnb short-term rental? Yes, technically you can. We don't advise it. And the main reason is the income is very unpredictable. That's reason number one. And you can open up the door for messiness and complications because that income does fluctuate month to month, and it is harder to track and document consistently. You also have those seasonal variations, and it is just more complex. And this is a big one here: is the Airbnb regulation risk. Tomorrow your municipality can just come and say, hey, we're not allowing this anymore, and then what? Then we got to scramble and look to get some long-term renters in there, and sometimes it just doesn't work with the locations that some of these properties are in. So we always veer away from it. We don't really set many clients up with short-term rentals with cash jamming. Yeah, so just stick to the long-term rentals with that predictable monthly income. It keeps everything cleaner and it's easier to manage. Question 15, what's the biggest mistake people make mixing the deductible and non-deductible debt? And here's some examples. I'm just going to leave it here for a second. We kind of like hit on this a lot here, but it's pretty obvious. Like don't use it to buy a car. Just use it specifically for the cash damming strategy. If you think anything is going to be mixed from a personal use perspective, like always check in with your accountant before you do it. Question 16, will I get audited? So you will have a greater chance at some point to get audited. If you have your expense tracking dialed in and you have the right structure up front, you shouldn't stress when this happens. It's going to be much, much easier for you when you have to prove to the CRA what you're doing, when you have everything structured properly. Question number 17, what do I do with the HELOC balance? So you've got three options here. This is one I get quite a bit. You could keep it as, so when clients ask this question, it's usually like, I'm stuck with this HELOC balance. Like, what's the point in doing this if I'm just going to be left with this balance? Well, keep in mind that balance is going to be less than what your mortgage was initially. So let's just say you started with a 500K mortgage and you run cash damming and you get to the debt conversion stage. So your mortgage is completely gone and then you're left with the HELOC. Usually it's, I'll just throw a number out there. This isn't accurate, but it could be 300, could be 350. It's going to be lower than what your initial mortgage amount was. So at that point, you've got some options. You can keep it as a tax deductible loan and make interest only payments. So that's option one. That's reserved for people that are more on the aggressive side with investing, and maybe they're still a bit on the younger side and they want to continue growing their portfolio. Then they don't want to make additional extra payments to tax deductible debt, so they're going to keep it as a line of credit. You can keep it as that tax deductible loan as discussed, but then you chip away at it with the payments of choice. So you can keep it as a HELOC, interest only payments, but maybe one month you're like, I'm going to toss a bit extra to pay it down. That's option two. Option three, I like this one. Convert it to a regular mortgage component. So there's nothing that doesn't allow you to convert that to a regular mortgage and make your payments as you normally would with your mortgage, but now it's tax deductible. So that's reserved for someone that wants to be mortgage free as fast as possible and making those regular payments. So there is no right or wrong answer there. The nice part is you do have that flexibility at that point. So the bottom line here, guys, is that rental cash jamming is a pure tax strategy. There's no investment risk here. There's no market volatility. It's just smarter cash flow management at the end of the day. Like I said at the beginning of the video, if you own a rental property and you're not running it, you're just leaving the returns on your investment on the table. And last note here, if you own a rental property, you're already paying for those rental property expenses. You're already collecting that rent. Why not structure it in a way that makes your personal mortgage tax deductible as well? So if you are interested in running your scenario, there's a link down below. You can book a call with our team and we're happy to set up a custom budget for you.